Okay, so today I'm gonna start out with a lecture on reading charts. So right now, let's quickly go to Yahoo Finance. So go to Google, type in Yahoo. So when you go to Google and type in Yahoo Finance and click on the link to that website, you'll be transported here. So go to the bar over here and type in the ticker sign of the stock you want to research. So today I'm going to use Apple as an example. And here in Yahoo Finance, you will see like all of the some fundamental indicators of Apple and some other stuff. So you can go to chart here, and it will show this chart right now of Apple. As you can see here, you can like change the intervals. So here I'll make the interval 1 day. And you can see here's like a line chart. Does anyone know what the gray square boxes with these on them mean? Like the gray boxes here. Okay, well, these square boxes here actually show the dividends like Apple give out. So here you can see that on August 11th, it gave out 24 cents as dividends. And here, the gray boxes with the S's on them mean like show the splits. So you may have like heard of splits in a book or read about them. They're basically like splitting one share into 4 smaller shares. So as along with the line chart, and you can like fiddle with this, there's also the candle chart we'll talk about today. As you can see here, the candle chart is basically shows these long rectangular boxes that are either green or red over here. And as you can see here, they have like 2 small tails, like a candlestick. So I'm gonna show you guys how to read these. Can you guys see my screen over here?
Yes.
Okay. So there's 2 types of candlesticks. A bullish candlestick, which shows a positive return over the time period, and a bearish candlestick. The bullish candlestick is green. You can see there's this body here and these 2 tails. The so the upper tail here is called the upper shadow. The lower tail here is called the lower shadow. And then the body in the middle is the real body. Okay, now let's just look at the bullish candlestick for now. The lowest point in this lower shadow here is the lowest price that day. So you see you can see the point here shows the lowest price for that entire day, or like the entire time period. So today, I'm just gonna pretend the time period for this candlestick is 1 day. So this shows the lowest point or lowest price that day. The upper shadow here and the tallest point in this upper shadow shows the most expensive price that day or the highest price that day. So far, is everybody following me or are there some questions? It's okay if you have any questions.
What does open means? Like when the market starts?
Open basically means like the price when the market opens. So you know every day, well, except the weekends, the market opens and then closes. Well, the open shows the opening price. So like when the market opens that day or that time period or that week or anything, like the price. So did I explain that clearly or do you need me to repeat that? Okay. Well, you can see the body here. The lowest line for this is the opening price. And this line here shows the closing price. So back up here, you can see, let's take a look at this green one here. The opening price is about 180, 384 something. And here's the closing price. The closing price here is about 187. Well, this one doesn't really have any significant tails, but here you can see there's a tail here. Okay. Now let's look at the bearish candlestick. The bearish candlestick basically is like a negative candlestick. It shows like that time period, over that time period, the stock price decreased. So obviously this is like the highest point that time period, and this is the lowest point that time period. Since this is like a bullish, no, it's like a bearish candlestick, since this is a bearish candlestick, the closing price has to be smaller than the opening price. That basically shows the market went down. So the opening price is always higher than the closing price. Okay. I'm gonna go here. So can anyone tell me what this is? Can you guys see my like marker? Like for this candlestick, what's this? Like what is this, the opening price or the closing price? You can just split it out here.
Close.
Closing price. And is this the opening price or closing price?
Open.
Okay. And is this the lowest point or the highest point?
Lowest.
Yeah. Because you can see here, for example, here, this is the highest point over that time period, which happens to be 1 day. See the intervals? And this is the lowest price that day. This is a positive candlestick, which means this is the opening price. And since it gained, like it gained money that day, since it's green, this is the closing price. If you take a look at this candlestick, this is red, right? Which means over that day, it's decreased. Its price decreased. And so since the price decreased, this is the opening price and this is the closing price. The closing price is lower, as you can see. The opening price is about 184, but the closing price is around 183. Does anyone have any questions so far about this?
I just joined and I don't understand any of this.
Okay. Since we're about to move on, then there's a recording. So if you look at it later, you can see the recording. Right now, we're analyzing candlesticks over here. Just like show the slides to you guys really quick. So right now, Damien, we're analyzing like I'm teaching you guys to read charts, especially the candlestick chart. So here's the slide. I'll just repeat this really quick in case like some people didn't hear me that well. And this can be a review. So here's a bullish candlestick, which meant over that time period, the market went up. This is the lowest price for that time period. This is the highest price for the time period. This is the opening price for the time period, which means, so basically the opening price is the price at which the market opened for that time period. So if this time period is 1 day, then this shows the opening price for that day and like what the price was of the market. This shows the closing price. So when the market, like the stock market closed, how, like what the price was. This bearish candlestick, which is red, is about the same thing, except here it's switched. Since the bearish candlestick means that the price decreased over that time period, then the opening price has to be greater than the closing price, since the price decreased. This then shows the opening price, this line, and this shows the closing price. This is the lowest point for that time period, and this is the highest point for that time period. So here's like a chart of Apple. Here's a candlestick chart. This, an interval for a candlestick is 1 day. Right here, so right here, this is like the opening price for this is the closing price, like for the green candlestick, since it's a positive one and the market went up. This is the closing price, and the one here is the opening price. This is the highest point that time period, and this is the lowest price for that time period. And you can see for this red one, this is the highest price, the lowest price. And since this is a red candlestick, this is the opening price for that time period, which happens to be 1 day. So when the market like opened that day, it was about $178. And when it closed, since the price decreased that day, it's about $177. So right now I'm just teaching you guys this because it's good to because analyzing charts is pretty important. And this is the candlestick chart is one very popular way to plot charts. Okay, does anyone want me to repeat this? Yeah, Isabella?
I have a question actually. So you know how at the bottom there's also green and red things?
Oh yeah, that's a really good question.
Yeah. Some of the candlestick things are like green, but then the bottom is red. So do you know what that means?
Wait,
For
are you
example, like August 18th, like can you go to August 18th or something? I'm gonna show you.
here?
Or yeah, I think it's 18th. But the candlestick is green, but then the bottom is like red.
Okay, yeah,
So
sometimes it happens. Okay. Oh, like this? Yeah. So actually, you know these bars here? These show the volume of trading. So for let's say August 22nd, the green bar here shows how many people like bought or sold shares of that stock. So here, this shows like the number of people that traded at stock and stuff. So sometimes it's red, sometimes it's green. You don't really need to like focus on that. This just shows like the volume of people who traded at stock. So is that clear or like? Yeah, this doesn't really show the price change. It's just like the number of people who bought or sold that stock. I think usually the red means that more people sold the stock or so. Yeah. So usually if the candlestick above is red, then the bottom is red, okay? Sometimes maybe just like a few inaccuracies like here. But usually like if the candlestick above is red, then the bottom is red. If the candlestick above is green, then the bottom is green. Sometimes they plot it wrong or something, but usually it's like that, okay? Okay, so does anyone have any more questions about this? This is sometimes kind of confusing, but like, okay, so I'm gonna move on from now. If you like later on, if you forget this, you can always look back on the recordings. Okay. So now let's move on to the questions. So the author in the book wrote, "The internet is far from the first innovation that changed the world. The railroad, telephone, the car, the airplane, the TV, etc., can all lay claim to the revolutionary effects on the average life, or at least on the prosperous top quarter of the global population. These new industries spawned new companies, only a few of which survived to dominate the field." So basically, what the author is saying is that a lot of revolutionary industries only have a few really big companies. Like no, these industries used to have a lot of new companies, but like only a few actually survived and then dominated the field. So can you give an example of an industry in recent years? Like that's pretty revolutionary, but which only has maybe one or two companies that actually dominate like the industry. Can anyone give an example? Okay, Kai?
Apple, probably.
Oh yeah, that's a really good one, Kai. Excellent. So the smartphone industry or phone industry is one of those revolutionary industries. There used to be a lot of different companies in that industry, like BlackBerry, I think there's this one called Nokia, whatever, a lot of other big companies, but there was a lot of competition between those companies, and in the end, only like a few companies survived, and they're mostly really big companies now. Like the basically the main companies in that industry are Apple and Samsung. Those two are the main companies that sell cell phones, and they're like the only ones, except for maybe one or two other really small little startups. But they're basically Apple and Samsung are basically the only companies in that industry. Well, I mean, okay, I take that back. they're the only companies in the USA industry or like in the American industry. There's a lot of other small companies like in other countries, i.e. China, India and stuff, but mostly it's just these two companies in America for clarification. So can anyone else give another example of an industry? Okay. Well, there's a few industries like this. For example, the airline industry, like the airplane industry. Um, there are a few like really small companies, but mainly in the airline industry, it's only four big companies. I think United Airlines, American Airlines, Southwestern Airlines, and Delta Airlines. These are mainly like dominate the field. There's a few smaller companies like Spirit and stuff, but those are mainly really niche companies. Like they only exist in a few airports, or the service isn't that widespread. But mainly it's just those four companies. So Chloe, do you have a question or answer?
No, like um, the technology industry.
Oh yeah, that's another. Well, I mean, technology is like a broader industry, but yeah, right now there's mostly just a lot of big technology companies and some smaller companies. Oh yeah, and in the chat, Evan gave another one, hardware for AI industry, like NVIDIA. Yeah, that's another really good like answer, Evan. That's like a really good one. I was waiting to see if one of you guys mentioned that. Also, if you guys have an answer, could you please like raise your hand or something instead of pasting it in the chat, unless your computer or your electronic has some communication issues and you can't like unmute yourself. So NVIDIA is another company with a really big moat, I'll say. A moat is like a it's like when one company dominates the entire field and like other small companies can't compete with it. For example, Apple and Samsung have really big moats too. So those moats are so big that other companies they simply can't compete with Apple or, for example, NVIDIA, because they can't make the good enough products, or not enough people are using those products. For example, NVIDIA or whatever, that makes hardware for AI, like some computer chips and stuff. Well, NVIDIA is one of the only companies in that industry. There's a few really small companies, but NVIDIA is the main um company, and a lot of other technology companies, like those big ones, buy from NVIDIA. NVIDIA also has a really high return because of this. So, for example, if their product only costs $100 to make, they're charging like $1,000, for example, or even more. And even then, a lot of people still want to buy from NVIDIA because it's the only company that makes really good hardware for AI. So people are buying like things from NVIDIA like at really overpriced rates, but they can't do anything about it because NVIDIA is like the only good company in that industry. And other companies, they can't compete with NVIDIA. And many really tried, but they can't. So NVIDIA has a really big moat. Chloe, do you have another question? Okay. Now let's move on to the second question. In this chapter, oh yeah, are you guys following me, by the way? Does anyone have any questions? Okay. In this chapter, the author believes that an amateur investor can pick tomorrow's big winners. Based on the author, how does an amateur investor find really big winners? Does anyone have any answers to this? So how does an amateur investor find tomorrow's big winners? Wait, before I continue, I actually have a question. How many of you guys read all 52 pages? Or 54? Okay, one? Okay. Well, that's okay anyways. Like, I know the pages are really long and not everybody has the time. It's okay if you only read some. Based on the author, and this is like one of the main topics of this book, but based on the author, how does an amateur investor find tomorrow's big winners? Okay, so I'm just gonna answer that question. So, an amateur investor can find tomorrow's big winners by just looking around themselves. Like the author said, he found many of like his best companies by just like looking around. For example, if he likes a product that a company is making, I think he mentioned the company called Le Eggs, which make stockings, and like plastic eggs. If he found a product that is really unique and that he likes or that he thinks will sell very well and is selling very well, he does some research on the company. And then if the company turns out to be a pretty good company, like by looking at some fundamental indicators or some other indicators and stuff, um, um, he can like find, and if he finds a really good company or a pretty good company, he'll invest a lot of money in it, or invest in some money in for some money in it. So he found a company called Le Eggs, which I think quadrupled something in price. If by just asking his wife about any new products that were really hot or anything, and he did some research on the company and bought it, and it paid off a lot. So you can find tomorrow's big winners. Everybody can, by just looking around, if you looking around at the everyday things, for example, this computer or your phone or a drink you really like. There's this drink called Celsius. I'll show you. This is a drink called Celsius. I don't know if you guys have seen it, but this was actually in Costco, okay? And it's a really good drink. I think my family bought it too. Turns out this company actually had stock. Um, and the stock turned out to be really good. Like, it increased 3,882.28% over the past 5 years. It went from from $4.57 to right now it's like around $200. And if you had bought this drink at Costco or somewhere else, my family bought it too. And I drank it before, except I didn't drink that much because it had caffeine. But like, if you had bought that drink and then you thought it was a good drink, because it is, and you done some research on the company, found out it had stock, and if you'd bought it around here, you could have gained so much money. Gained 3,882%. That means the price was about 38 times like its original price over the past 5 years. Like around 2018, if you had bought it, you would have gained a lot of money. As you can see, that's one example. There's a lot of companies that are really big winners. You just have to look around you, like find some products you think are pretty good, research them, and it'll pay off. Okay. So now, okay, now let's move on to question number 3. And I think I should hurry up because I have like a lot more content. But anyways, so assume Disney is your favorite place to play. And I know maybe for some people it's not, but assume Disney is your favorite place in the whole wide world, okay? Will you buy Disney stocks like just because of that? Oh, and why or why not? This is like kind of an open question.
So like in the book it says, uh, don't just buy stocks that you think are good products or you like to go there because sometimes they have like their fundamentals aren't good. Um, their the their leadership isn't good, their management isn't good. So you shouldn't always just because you like something you will buy the stock. You should go do research as Elisa said, and you should look deeper in the company.
Yeah, excellent, Chloe. Um, so like that hit on the point though. Some people have different opinions though. But those were great opinions, Chloe. So Olivia?
Um, I would possibly get it because I know something about it, and it's better to know something than know nothing and just randomly buy because you just want stocks. And I would first maybe do a little research. But if I know enough about it, I wouldn't. But I would probably buy it.
Great, Olivia.
Yeah.
Kristen?
I think that like I would be interested in whatever my favorite places are, but I wouldn't just buy their stocks based on that fact alone. I would also do some research. But if I'm interested in the place, then that'll attract me first.
Yeah. Those are really good points. Isabella?
I would buy Disney stocks because I know like there's new little kids almost every single day. So Disney is like growing, well not I don't yeah, not as fast now, but still. And also there's Disney movies and stuff like that. So I would still buy Disney stock.
Yeah. These are all really good. Personally, I wouldn't just buy Disney stocks because it's my favorite place to play. And as the book mentioned, and as most of you said, you can't just buy a stock because you like it or it's your favorite place to play or it's your favorite product or something. You first if you like it if you have a favorite product or place or you like this thing or something, you should do some research on the company and determine if it has a stock. And then after you like do the research on the company, you also have to look at the stock itself, like some fundamental indicators and like do some research on it, like if the number, for example, if the number of people who are visiting Disney every month has slowly been decreasing over the past years, or if Disney has bad management or anything, or if it has good management. If I did a lot of research on the company and I determined it's a good company, I would probably buy it. If not, then I wouldn't buy it. Because it's okay to enjoy a company's products or like services or something, but if it's a bad stock, then don't buy it. So actually let's do a case study on Disney. So you know there's this thing called ROE or return on equity. Warren Buffett uses return on equity And he thinks it's one of the most important fundamental indicators. So ROE, usually a good ROE should be above 20%. That's such a Disney's ROE. So can anyone tell me what Disney's ROE is? You can just blurt it out once you found it. No, that's just such a myself. Okay.
According to filmvids.com, Disney's ROE is 2.30%.
Yeah, that's basically, I just searched it up. That's basically what I got to, around 0.027
I
for.
said 2.30.
It's the same thing sometimes. They just haven't updated it yet, or or just like some like not updated it yet. But it's around the same thing. So it's around 2.3, 2.7%. Well, a good ROE ratio should be 20% or above it. So if you're looking like at the ROE ratios, then maybe Disney stock isn't that good to buy. Okay, let's move on. I think question. Well, so the author wrote, corporate profits are up 55-fold. You guys know what 55-fold is, right? Okay, so corporate profits are up 55-fold since World War II, and the stock market is up 60-fold. 4 wars, 9 recessions, 8 presidents, and 1 impeachment didn't change that. An impeachment is when like the government thinks this president should be kicked out because they're not like governing the governing America, right? So how do you understand these sentences? And this is a pretty open question too. Also, guys, if you have anything to say, can you please say it in like, could you please say it in the Zoom meeting, not in the chat? If you actually have anything to say, please say, like anything important to say, please say it out loud. Okay? If you don't really have anything to anything important to say, don't spam the chat or anything. Of course, if you have an answer or something and you can't communicate out loud, then maybe you can sometimes put your answer in the chat. But otherwise, if you actually have something to say it out loud. If you don't want to say it out loud, then don't put it in the chat. Also, Chloe?
Um, I understand it as even when bad stuff happens, like wars in this example, doesn't mean the stock will always lose money because you never really know what happened. Maybe sometimes the wars actually help the stock. Like in the book, I think it tells maybe if the war needs airplanes and there's a company that manufacture airplanes, then maybe the stock will grow up because they have a great opportunity to earn money. So yeah.
Yeah, that's an excellent view. Thank you for answering, Chloe. So Isabella?
I understand it as yeah, basically sometimes bad things will happen, but we'll always recover and go back up. You know, stocks are like that; they go up and down and stuff. Yeah, that's basically it.
Okay. Yeah, great, Isabella. Personally, how I understand these sentences is the market will recover, even if there's a lot of bad things happening, recessions or wars or like impeachment stuff, or if there's some really big recession or something, eventually the market will recover. You see here, at this point, I think around 1930, the stock price went down a lot. And it's even a little scary, I guess. Most people around here sell the stock around here when it was going down. But they later regretted it because the stock recovered in around 25 years and later went up. So if they had kept the stock, they might have saved themselves from a lot of losses. I'm not. If they had held the stock, they might not. If they had like sold the stock over here, they had actually lost money. If they held the stock, they wouldn't have lost anything. Just some time. As you can see here, the market always recovers. So it's no use panicking, just selling it at the bottom, because you'll regret it. Okay. Now, let's go on to the introduction. The advantages of dump money. So what's the author's rule number 1? It's on the first page of the introduction, the advantages of dump money. In case you forgot. So how do you understand it? I'll give you guys a moment to look over the rule number 1. Sorry, okay. So Olivia, Olivia, do you want to share the rule?
Sure. So the rule is to not listen to what the professional investors say, because they're just like average people who market themselves to look really good. And the way I understand it is that sometimes professionals can be like good, like hairdressers. You like normally they're better at cutting hair than you would be, but like half the time you'd be better as an investor than as the quote unquote professionals.
Yeah, great, Olivia. Thank you. So does anyone else have a slightly different view or anything? Okay. So basically the author's rule number 1, as Olivia said, is that to not trust professionals, which I think is kind of ironic since he's a professional himself and he's just saying not to listen to him. But like the author basically means like generally to not trust a lot of like so-called professionals or magazines or newspapers and stuff, because for like 3 reasons. Number 1, they might be wrong. Number 2, like sometimes people they look at like what these legendary investors are were buying, because those legendary investors have to share what they're buying like 40 days after they bought something. So some people look at what those investors are buying, and then they're like, oh wow, Warren Buffett bought some shares of Capital One, I'm gonna buy it or something. But thing is, since they're required to share it 40 days after they bought the stock, you don't know if they already sold it, like maybe a few days after they bought it, or maybe a month after they bought it. You don't know when they sold it. Maybe they bought it 40 days ago and then after 30 days sold it because they predicted it was going down. But if you followed them, you would have bought maybe some shares of the company and it would have gone down and then you would have lost money. And the third is like some professionals, they like try to sound really impressive, but in the end, it's just not really worth it. You just have to do your own research. Oh, well, I mean, I just answered question number 2, so I'll skip it. So question number 3. Why does the author think an amateur investor has advantages over professional investors? Okay, Kai?
They could be younger, so they have more time.
Yeah, that's an interesting view. Livia?
Most of the professionals, when you put their money with them, they're gonna take like a huge percent of your returns. And if you just went by yourself, you wouldn't have to pay that.
Yeah, great, Livia. Isabella?
So I think sometimes professional investors, they want to like drag you like not like to the stocks that they support sometimes. And sometimes like those stocks they like steal your money. They're like the behind the scenes, they're like actually bad people. So if you go by yourself, you've always like I guess articles and books around you. So those maybe could help you better.
Yeah. Great, Isabella. Personally, like these are all good answers. Personally, I think an amateur investor has advantages over professional investors. Some advantages, like some reasons of this are number one, professional investors, they actually have to buy stuff because maybe they own mutual funds or something. And in mutual funds, you are forced to buy stocks. So usually just like forced to buy some stocks or anything just to look good. Meanwhile, an amateur investor, if like they don't like a stock or like the stocks in the market or something recently, or if the market is going kind of down, they don't have to buy any. They don't have any pressure to buy any stocks. Also, an amateur investor has some advantages because professional investors, right? They want to look cool. Um, Meanwhile, an amateur investor doesn't have to look cool. They can just go around analyzing Dunkin' Donuts and buying donuts there. While professional investors usually are pressured to look cool, and mostly they're just doing some research about this unknown company that does something they don't really know about, or like that makes some super complicated product that they don't know anything about. Meanwhile, an amateur investor doesn't really have to look cool. They can just like look around themselves, find some good companies that don't really that even though some companies don't make really impressive stuff, they actually have really high returns. So an amateur investor doesn't have to pick companies that make really or advanced stuff to like look good. They just have to pick some good quality companies. Okay, now let's move on to a few questions. I think this is the only question for chapter 1. So this is like an open question. What sentences, sorry, that was a typo, sorry. So what sentences or opinions do you like most in this chapter or previous chapters? This is an open question. So I'll give you guys a few moments to look through these chapters. So what sentences or opinions do you like most in this chapter? Okay, Chloe.
Will Rogers, I like the quote from Will Rogers where he said, don't gamble, take all your savings and buy some good stock and hold it till it goes up, then sell it. If it don't go up, don't buy it.
Oh yeah, that one. I think it's on end of page, like chapter 1, right? Yeah, I remember that one. Yeah, it was at the end of chapter. It was on page 54, right? Yeah, that's a pretty good quote. It's a fun quote. So thanks for sharing, Chloe. Isabella?
I don't think it's in chapter one, but I was gonna share the story thing. So I talked about this, I think it is in chapter one. But anyways, this guy, it was a story he made of this like fake person. His wife told him he liked this store, and a lot of other people were also saying that. But then he didn't buy that stock and bought another one, and so that stock went down. And then when he finally realized it was on the Wall Street list, he bought it. And then by then the stock's like best time had already passed, so he never earned anything.
Oh yeah, that's a
Yeah.
it's a really good story, Isabella. Yeah, it's the one about the hairy guy, right? Well, not hairy guy, like hairy age or whatever. The one about like, oh yeah, that story is really good. Yeah, that story is like one of my favorite parts of this book too. It's like where that hairy guy like is trying to like buy some stocks from these companies that make some incomprehensible thing or something, or companies that are on the Wall Street list. So instead of doing the research himself, he's just like looking at the Wall Street list and like buying some stocks off of it. And even though his wife gave him like really good advice, he didn't listen to it. Finally, when his like wife's like favorite shop or something went on the Wall Street list, he bought it. But by then, the store was like outdated. It was no longer good anymore, and it still lost him money. Yeah, that story was good. Um, so does anyone have any more like does anyone have any other opinions or something? It's okay. This is like an open question, and like there's no like right or wrong. Okay. Mm, so this is like a case study of David Swenson's portfolio review. So can you guys like go wait, hold on. Can you guys go to the spread? Oh, I'm gonna paste it in the chat. Oh yeah, this isn't. You know, like last time when you guys like did the David Swenson portfolio thingy like competition. Does anyone remember that competition?
Yes, I do.
Yeah. So like where you had like $300 or something, like onion
We
money.
had 400.
Okay, I mean it's the same thing. We can just calculate the percentages. So can you guys click on the link to the spreadsheet, like that I pasted in the chat? And can you guys go there? So now we're gonna do another update. Okay. So can you guys like for example,
I
guys
can't do Google Docs because I don't have a Google account, and my dad said I can't set up one. So
okay, but you know, Damien, I don't think you're in the spreadsheet. I don't think you took place in this competition. If you did, I don't think you reported it. If you report it right now, I guess oh, the registration already passed. So you can like share if you want, but you're not like technically involved in this competition. I'm really sorry. Um I mean you can like report what you can report. Okay, for some reason, who is messing this up? Okay, who is doing that? Messing up the spreadsheet. Oh,
你让他们 自己先回去之后把它填下来吧。你再讲下个 slide 吧。
You know what? I'll just let you guys like fill this out. Oh, gee. Okay, when you get home, you can just fill this out. And please like try not to like mess anything up, okay? Accidentally or anything. I'll just move on because it's like I'm kind of running out of time and I still have a lot of things to cover. I'll just move it next time though. Okay. So here's the performance of the original David Swenson portfolio from July to this Friday. And you guys can compare it. Oh wait, they lost money. So you guys can compare it and with your like portfolio. And remember this though. It doesn't matter if like you maybe some of you guys are gonna like have higher returns than the David Swenson portfolio. But you know, these are only a few months, and maybe some of you did really good, or some of you did pretty bad, or anything. But it's just for a few months. Maybe you were incredibly unlucky or lucky, or the stocks and like bonds and stuff you bought just went up or down a lot. So these are just for a few months. So like the result for this isn't that significant. If you look at it over a very long term, then it might be really significant. But right now we're just doing a small case study, okay? But you guys can compare your portfolio's performance to the David Swenson portfolio. Okay. Today, I'm gonna be sharing 8 golden rules, and that's it. But since I don't think we have a lot of time today, I'll just share 2, and I'll like put the rest for next time. And I also don't think we have time to do the game show. Okay, never mind. So don't even have time to do the game show. Okay. So rule number 1 of the 8 golden rules is to think long term. And I'm just gonna skim over this text, because it's from the book. So trying to time the stock market is like gambling. You might as well just take your money to Las Vegas and lose a day at the casinos and stuff. So those who can successfully navigate the stock market are not speculators or gamblers who are gambling their money or taking bets. They're investors. So investors, like good investors, can beat the market because they think differently, smarter, and longer term. So this thing called time horizon arbitrage, which means that if investors learn to think long term and can see beyond some small like noises or like ups and downs, they can gain a real upper hand. So this is a real life example. In 1964, the American Express was a great company, but the stock was going down due to this insurance scandal. And it's a long story, but the stock was going down because of this small scandal. However, that happened to be exactly the time when Warren Buffett began purchasing the stock and bought lots of shares of the stock. What this shows is that the best investors look beyond like short-term like movements or ups and downs, short-term distress, and they keep their eyes on the long term. So in the long term, the American Express is probably a great company and will probably like recover and go up. So Warren Buffett saw this and like bought lots of shares of the stock, even though the stock was going down at that time. Oh, by the way, are you guys like, do you guys have any questions so far about this? Anybody? Any questions? You know, questions can be good sometimes. Well, most of the times. Every time. Okay, so now let's move on to rule number 2, which is the final rule I'm gonna be sharing today. I think we're already past time. So I'll just talk about rule number 2 today. So rule number 2 is that good companies make good investments. So people need to understand that investing isn't like placing a bet on a football team or something. Investing is not trying to get the quarterly press release like maybe a few minutes before everybody else. Fundamental investing is like buying a piece of investing is buying a piece of a great business or a share of that business. And your investment portfolio is like only as good as the sum of the companies in that portfolio. So good companies are like ones that have unique advantages that others can copy. They generate high returns of capital and they don't need to borrow a lot because their business is self-financing. So it's better, as this guy quoted, it's better to buy a wonderful company at a normal price than a normal company at a wonderful price. Because even though you might get a really good bargain on like this fair normal company, and then the company might not like gain a lot over the long term. But it's far better to buy this wonderful company that will probably like gain a lot of your money, gain a lot of money at this normal price. And if you buy shares of high quality companies at just reasonable normal prices, you end up with a high quality portfolio. So this is a really good quote actually. It's far better to buy a wonderful company at the fair price than a fair company at a wonderful price. So that concludes rule number 2 and this meeting. Does anyone have any questions about this? Okay. So thank you and see you next time. So thank you for this meeting. Thank you for attending this meeting.
Bye.
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 Now I'm good at.
Bye.